President Trump has recently officially selected Kevin Warsh as the next Federal Reserve Chair. So the big question for everyone in real estate is simple. Should we expect lower interest rates because of this? Before you adjust your expectations, your pricing, or your underwriting, let's slow this down and walk through what this actually means. Kevin Warsh has just been selected to replace Jerome Powell, pending Senate confirmation. This is the leadership transition at the Federal Reserve. It is not an immediate policy change. It is not a rate cut. It is not a signal that mortgage rates drop tomorrow. It is a shift in tone, leadership style, and markets care about tone. Let's talk about who is Kevin Warsh. Kevin Warsh served as a Federal Reserve governor during the 2008 financial crisis. He was in the room during some of the most aggressive monetary easing in modern history. He saw zero interest rates. He saw quantitative easing. He saw the impact of extending stimulus on asset prices. Over time, he developed a reputation for being cautious but prolong easy money. He has historically emphasized inflation awareness and financial discipline. That is important because many people are assuming this selection automatically means fast rate cuts. His history does not support that assumption. What most people are getting wrong. The common narrative right now sounds like this. Trump prefers lower rates. Trump selects Warsh. Therefore, lower rates are coming quickly. That skips over a key point. The Federal Reserve still responds to data, inflation, employment, financial stability. Even a new chair operates with those constraints. If inflation remains above target, aggressive cuts are unlikely. If economic conditions soften materially, gradual cuts are more realistic. The data still drives the direction. What actually moves first? Before rates change, expectations change. The bond markets respond to perception. The 10-year Treasury yield often moves before the Fed makes any formal adjustment. Mortgage rates will follow those yields. That means real estate can feel movement before the Fed ever announces anything. So if you're watching this situation, watch bond yields, watch inflation prints, watch how markets interpret Warsh's tone. That will matter more than the headline itself. What this means for different people in real estate. Now, for buyers, expect possible volatility. Do not confuse short-term movement with long-term direction. For sellers, do not assume affordability relief will instantly increase demand. Watch showing activity and pending sales. For investors, underwrite conservatively. Assume stability before relief. Now, for developers, do not model your pro forma around a rapid return to ultra-low borrowing costs. That environment was very unique. For agents and brokers, expect sentiment to move before transactions do. 3 realistic scenarios. Let's think in practical terms. Scenario number 1, inflation continues to moderate. Growth softens, the Fed gradually lowers rates over time, mortgage rates ease slowly, transaction volume improves steadily. Scenario number 2, inflation proves sticky. The Fed prioritizes pricing stability, cuts are delayed, rates remain higher longer. The market continues to adjust to those new baselines. Scenario number 3, financial stress appears somewhere in the system. The Fed uses targeting tools instead of broad rate cuts. None of these involve dramatic overnight rate relief. That is the key takeaway. What real estate should actually watch? Instead of focusing on the new chair, focus on measurable signals. They're out there. Watch the 10-year Treasury yield. I say this all the time. You have to watch the 10-year Treasury. Watch mortgage rate trend reports from Freddie Mac. Watch bank earnings commentary about lending standards. Watch the time on market in your local area. Those indicators will tell you how conditions are shifting. Leadership changes influence tone. Data drives the decisions. So why this moment matters. This is not 2009. It is not 2020. The Federal Reserve today operates in a world more sensitive to inflation risk. New chair inherits that environment. That makes dramatic pivots less likely and gradual recalibration more likely. Real estate performs best when there is clarity, even if rates are not ultra low. Stability matters more than speed. Now, what's the takeaway here? So should real estate expect lower rates because Kevin Warsh was selected? Not automatically. Expect tone shifts. Expect market interpretation. Expect gradual movement. Do not expect to switch the flip. If you stay focused on the fundamentals instead of reacting to every headline, you will make better decisions in any rate environment. If this kind of clear, practical breakdown is helpful, make sure to subscribe. We're going to keep unpacking what actually matters in real estate without all the noise.